taking a look at a live shot of the opening bells on Wall Street as traders return following the July 4th holiday weekend. I'm the Yahoo Finance executive editor, Brian Sozzi, and this is Opening Bid. Here on Opening Bid, we bring you the investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with your money. Let's get a quick check on what's hot out of the gate and send it down to Yahoo Finance senior reporter Allie at the NASDAQ in Times Square. Allie.
Hi, Brian. Well, taking a look at the major indexes, we are pulling back, especially for the S&P and NASDAQ, off of those record highs here. The S&P 500 is down around 0.3%. The Dow is off around 70 points, and the NASDAQ is the biggest loser of the early morning session here, right out of the gate, down about 0.5% here. I also want to take a look on crude oil. This is something, Brian, that we'll be discussing throughout the show after we saw those surprise supply increases from OPEC. Crude is currently trading above $67 a barrel here, but there are calls on Wall Street that we could see crude oil dip below $60. So something that we'll be discussing a little bit later here. And finally, let's take a look on Treasury yields. You're seeing the 10-year yield trading around 4.36, and the 30-year yield is hovering at 4.89. Now, this comes after there's been a lot of expectation over the past month or so that the Fed could issue more rate cuts than previously expected, but we did see that stronger than expected jobs report last week, and that basically evaporated the chances of a July cut. So now there's a bit of recalibration on the investor side on what we could see with cuts. And then in individual movers, I want to take a quick look at Amazon ahead of the highly anticipated Prime Day event. We are seeing shares trade slightly lower today, down about 0.1%, pretty much flat here. And Prime Day, it takes place tomorrow, July 8th, and runs through July 11th. Year to date, Amazon has struggled a bit. We are only up around 2%. So compared to the broader markets here, hasn't been a big winner this year, but perhaps a successful Prime Day can change that outlook. Now, I want to bring up Adobe forecast because it looks like another bullish event. Adobe is predicting a record $23.8 billion in online spending for retailers. That represents around 30% year-over-year growth. Adobe said it expects steeper discounts, a rise in back-to-school shopping, and continued growth in buy now, pay later as we continue to see this consumer a bit stretched and a bit more price conscious. And then finally, Brian, this was something that was interesting to me. Adobe cited an increased impact of social media influencers on shopping behaviors. So there you go. Your favorite TikTok fashion guru could be moving markets this week.
Yeah, Allie, maybe folks out there are buying a lot of caffeine based on my recommendations. Who knows? I'm an influencer.
Yes.
Allie Canal, thanks so much. We're getting after it on this post-holiday Monday with your daily guide to the biggest market drivers of the trading day. Here's what I'm keeping an eye on. Number one, stocks are pulling back from record highs thanks to a fresh round of uncertainty from the Trump White House on all things tariffs. The president pledging an additional 10% tariff on countries aligned with BRICS nations, that is Brazil, Russia, India, China, and South Africa. Trade partners have a few days before that July 9th deadline to hammer out deals with the administration or face new rates effective August 1st. Number two, President Trump's sweeping tax cut and spending bill is officially law, a major win for the administration. Funding shifts and tax cuts could have big implications for the U.S. economy and markets in the months ahead. And number three, earnings are in focus this week. Results from Delta, Levi's, and Conagra on Thursday. Guidance will be key as investors search for more insight and warnings of uncertainty from inside the C-suite. Let's bring in our roundtable. LPL Financial Chief Technical Strategist Adam Turnquist alongside Yahoo Finance's Allie and Ines Ferré. Good to see you all. Adam, I want to start with you here because we are watching, of course, all things tariffs. Now, this is an issue that for the past month and a half, I would argue investors have forgotten about, sending stocks to record highs. Now that it's back in the discussion, what might trading look like in the very short term?
On a near-term basis, you can't overlook the prospect of a little bit of a pullback. When you look at the technicals for the broader market, around 20% of index constituents are overbought based on a momentum indicator that we look at. That's near the qualifier where you tend to get a pause or pullback in price action. We've had obviously an impressive run in terms of just the rate of change we've witnessed since April. So maybe the uncertainty ticking higher with some of the BRIC announcements and just the July 9th headline could weigh on equity market momentum on the near term, but I do think it is a buy the dip market right now.
Why is it buy the dip, Adam? And I ask that because from what we have seen on the tariff front, it still looks like tariffs will continue to be in place. And as we're on the cusp of earnings season, what company wants to see tariffs in place?
Good question. I think from the market's perspective, the White House has shown some flexibility on these tariff deadlines and the tariff rates. So for now, that seems to be the playbook, and we're sequencing more toward trade deals, not the sticker shock from Liberation Day. And on the earnings front, here I am, a technical analyst talking about earnings, but I would have to call it a catalyst. We've had pretty big downward revisions going into reporting season. I think it does set up for a low bar for earnings, around 5% earnings growth. That's down from about 9% expectations, so larger than expected cuts. I do think it could bode well for a beat. That tends to be the playbook in terms of quarterly earnings. We'll see how big that beat is, but I think right now a pretty good setup when you have solid earnings, decent enough economy, and pretty good momentum in the market.
Allie, at the top of the show, you talked about Amazon, and I think Amazon is the perfect tariff proxy. This stock has pretty much done nothing, hasn't really participated in this record-setting rally. What's the message from that in your view?
Yeah, and if you look at some of those other Mag 7 names like Nvidia, Microsoft, they've seen these outside gains, but Amazon has really struggled here. And I think it points to this consumer that is a little nervous about the trajectory of the economy. Right now, things seem pretty good. We had that solid labor report last week. That was a surprise to many on Wall Street. We have stocks at record highs, yet this is sort of the most hated rally. That's something that Fundstrat analyst Tom Lee described it, in the sense that there's still a lot of uncertainty out there. And there seems to be a lot of FOMO-driven names that have done really well, a lot of momentum plays. Even some of the meme stocks that we talk about on this show have outperformed this market. And what does that tell you? It potentially signals that maybe we're in a bit more of a frothy environment. Perhaps we're a little bit overstretched. So there is a possibility that we could see more of a pullback down the line, even as stocks have seen this resilience narrative play out over the past few weeks, and especially since the April lows that we saw. So I think on the consumer side, there's still the question of whether or not tariffs will trickle through into the economy, if that could weigh on growth, if that will lead to higher prices. It certainly will keep the Fed on hold for longer. It increases the uncertainty for the central bank, and we know the impact that that has on various areas for the consumer, especially when you think about mortgage rates and a lot of areas of the economy that the consumer has been priced out with so far. So that is the big TBD factor of this all, is how tariffs play out and trickle through the economic indicators that we look at closely.
Allie, real good points here, and it brings to light a new Yahoo Finance Maris poll that was out this morning. Hat tip to our Brooke DePalma. That full piece is now on the Yahoo Finance page. 80% of consumers polled have concerns about their personal finances, in large part because of these tariffs. My question to you is, Ines, where are you seeing some caution in the market? Sure, we're still at records, but there are some concerns starting to build in the market, notably around potential complacency.
Yeah, I mean, look, it all depends on how the consumer reacts going into the second half of the year. And if you have, though, the bigger spenders that are contributing towards the economy, that is what really is important. If they continue, if the higher income households continue to spend, that is what's most important, because they're the ones that are contributing most to the economy. But certainly, when you look at the lower income households, they are feeling squeezed, and you are seeing it in survey after survey.
Adam, I want to get over to you on this one big, beautiful bill. I'm going to ask you again to play fundamental analyst. I know you're a technical guy, but what excites you about this bill as it pertains to how companies might benefit from it? We're hearing a lot of things that were left out of the bill, like EV tax credits and various other things. Anything in here that makes you more bullish or more concerned?
I think just at a high level, the lack of any major surprises, the extension of the 2017 tax cuts, there was no incentive or no reduced corporate tax rate. I think maybe that was a little bit disappointing, but largely expected. So just the lack of any major surprises, likely a positive sign for the market. At least that's been the reaction. You talked about some of the energy credits and EV. That's been weighing a little bit on that space. So some potential headwinds in that realm. But overall, when you look at just the positives for the consumer, at least on the consumer side, I think there's enough there to get excited, maybe some offsetting factors for potential headwinds from tariffs and inflation that are included in the bill.
I had a new episode, Adam, dropped this morning on the Opening Bid Unfiltered podcast with Norway's Sovereign Wealth Fund CEO, Nikolai Tangen, and he brought up a good point about how he's concerned on what rising U.S. debt levels mean for the interest rate outlook. As you look longer term, let's say the next decade, how worried are you about rising debt levels leading to higher rates and potentially less returns for investors?
I think we're seeing it in the risk premiums in the fixed income market. You can look at term premium on the 10-year. Investors are simply wanting more yield to own longer duration. And the problem with our deficit is not going away. We're starting to see some progress, we'll call it, at least more focus in Washington. I think that's at least a good sign for now, but clearly more work to be done until we talk about reducing it in a material way. And until then, I think it could be hard for longer duration treasuries to really come in. That's why we're seeing the yield curve steepen as well. Of course, the front end of the curve more tethered to what the Fed's going to do, but certainly a problem. We'll see if tariffs help that problem or not. Depends on the forecasts that you're looking at in terms of how much revenue they're going to bring in and help reduce that deficit.
And lastly, earnings season kicks off this week. Delta, Levi's, Conagra Brands, all companies that I know pretty well. I'm really interested in, Allie, what these companies say about guidance. I went back and looked at Delta's guidance that it gave on April, which are a wildly different environment then compared to now. Looking for sales down 2% to up 2%. Earnings 170 to 230. The street's at 203. I look at Levi's. They shocked everyone a couple months ago, leaving guidance unchanged. That stock has rallied 38% in the past 3 months. What are you watching for in earnings, and how important is it that CEOs step up here and they give clarity, the clarity they didn't give 3 months ago?
That's going to be key here, Brian. The companies that are going to outperform are the ones that come out and say that they are prepared to handle this uncertainty. And as Adam was alluding to, we do have a pretty low bar. So as long as we consistently see some beat and raises here, I do think that will send stocks higher, even if we're at these record highs. I think for all the tariff talk, all the one big beautiful bill talk, earnings are the near-term catalyst for this stock market. So if you have companies that come out and say that, this is a better than feared outcome for us, what we've seen since we last reported is more improved than what we thought we would be at, that is going to be a tailwind here. So I think guidance is going to be important. Crossing that low bar is going to be important. And just being, honest with shareholders about where they see the business heading over the long term. I think for a company like Delta, which we'll report later this week, it's going to be a lot of focus on the consumer. And Wall Street is pretty bearish on the demand picture, at least through the rest of 2025. A lot of Wall Street analysts are looking ahead to 2026. And maybe that is some commentary that we'll hear more of as these companies begin to report. So focus on the consumer. But yes, as you were saying, definitely a big focus on guidance too.
I crave guidance. Give me that guidance, CEOs. I want it all. All right, straight ahead. We'll be back with our stock of the day. Your clue. It's the #1 trending ticker right now on the Yahoo Finance platform, dishing out those easy clues post-holiday. We'll be right back. Welcome back to Opening Bid. Checking in on the markets here. Red across the screen, Dow, S&P 500, and NASDAQ all lower. Looks like the NASDAQ leading us lower post-July 4th holiday. All right, let's dive into our stock of the day. You guessed it, Tesla, or I hope you guessed it. Tesla shares are under major pressure as President Trump and Elon Musk return to the public battlefield. The general vibe from those I've chatted with is that Musk creating his own political party is the last thing Tesla shareholders want to see. However, lost in the sauce today is that the new tax and spending bill signed into law by Trump ends the EV tax credit on September 30th. That's further bad news for Tesla, argued William Blair analyst Jed Dorsheimer in a note this morning. These happenings have me focused on the top institutions that own Tesla, in a very influential bunch that could begin to question their positions given the latest drama. Jumping into the Yahoo Finance platform, you can see Vanguard, BlackRock, and State Street own hundreds of millions of shares in Tesla. Now, if they decide to dump those shares because of all of these theatrics, it could add more selling pressure on all things Tesla shares. Still with me is my roundtable of pro LPL's Financial's Adam Turnquist, alongside our very own Yahoo Finance's Allie, Canal and Ferré. Ines, I had the team make up this board this morning of Tesla's board of directors. And I wanted to publicly show their faces. You have Robin Denholm, longtime, I believe, the chair of Tesla's board. You have James Murdoch, Fox executive. You have Kimball Musk on this board, recent member Jack Hartung, former CMO of Chipotle. What is this group of people doing to protect shareholders, to allow Elon Musk, their CEO, to come out here and create another political party? This is not what shareholders want to see at all.
No, it's not what shareholders want to see at all, and you can tell by what's happening to the share price right now. Look, the street is overwhelmingly calling this a distraction. Again, Elon Musk further going into politics. But one Wall Street analyst put it this way. He said, this may be his only path to protect what he has built. So perhaps you will see volatility in the stock, but the street is saying, this isn't what investors want, and this creates just more distraction. But this may be the only thing that he can do right now. What investors, though, are betting is who's going to win here. It is harder than what people realize to perhaps do to establish another party, a middle ground party. So what's happening to the share price right now may be what investors are thinking, that perhaps Elon Musk is going to lose on this one, but this may be the only option he has.
Adam, Tesla recovered before this latest dust up, but is this stock just a technical nightmare? Why wouldn't the bottom drop out as you have its CEO creating a political party, giving more people reasons to get out there and not even buy a Tesla, buy something from Ford and General Motors?
Right. I'd say the technicals here, a nice recovery, especially after Elon Musk announced he's leaving Doge and maybe focusing back on the company. Well, now we're getting the opposite of that news, digging further into his political career, picking fights with both Republicans and Democrats, stock responding here, breaking below its 200-day moving average. Now, that was a key level.
That's a bad sign. Adam, let me just quickly follow up. When a stock breaks below its 200-day moving average, that's really bearish, no?
In general, yes. Simply the 200-day moving average, think of that as the longer-term trend. So now here we are talking about a stock below its longer-term trend or moving average, taking out some additional support around 295 this morning. When you look at the technicals, at least on a short-term basis, it would not be surprising to see the stock move lower. We'll see how it finishes the rest of the week, but certainly the selling pressure, pretty critical on the technical chart, breaking that, again, longer-term moving average and some other important levels for Tesla here.
Allie, now Elon will always have his supporters, and you could go hop on X that he owns and see the retail supporters, retail investor supporters, but he is running the risk of losing other retail investors that have supported the company, but they have still viewed it more as a longer-term investment. This doesn't help their case or get them, I would imagine, more excited about owning Tesla shares or even buying this dip.
Right, and you were just mentioning some of those institutional holders of Tesla. And in the market in general, we've seen a bit of a disconnect between retail traders and institutional investors. It seems like the retail traders have really been leading this rally and dragging the institutions along with them. So if you start to tick them off, then you have a problem with your share price. And what Ines and Adam were saying, this is largely a distraction. This is a company that is struggling on the EV front. Their vehicle deliveries continue to underwhelm on that front, down year over year. So that's a big concern here. A lot of noise around this new political party. As you were saying, the paperwork hasn't even been filed yet. At the same time, though, Musk is one of the richest people in the world. He is influential. So you do have to take him seriously, which is why we're seeing this stock reaction today. But beyond just the EVs, there are still a lot of bulls out there on the street, and they're focused on autonomous driving. They're focused on robotics. Maybe that is the bullish silver lining here, even if we have this removal of the EV tax credits, because you still have some of those Wall Street bulls, like friend of the show Dan Ines, for example, that's holding firm on Tesla. And according to Bloomberg, the analysts that are tracked there, we have 29 buys, 19 holds, and 13 sells. So still a lot of optimism on the street, but you do have shares that are down 30% since the start of the year. So it seems like investor patience running a bit thin here for Tesla.
Adam, all these Tesla fans that hate me when I talk about Tesla in a negative way, I'm sending them to your X account. I'm tired of dealing with this crap. I'm sending them all your way. All right, it's time now for our question of the day. Do oil prices below the $70 a barrel market signal a recession is on the horizon? And as I tailor-made this question of the day for you, you are our oil pro. What say you?
Not necessarily a recession is on the horizon, but I will say for the shale patch, it certainly is. In fact, one of my sources told me this is absolutely awful for them. They will not drill new wells unless their oil is around $70 a barrel. You've got the rig count down that's now for 10 weeks in a row. You have the price of steel that's higher. You have the price of labor that's higher. So for shale, he's saying they are in a recessionary environment already. For the rest of the country or the rest of the world, I mean, OPEC Plus cited low global inventories. You've got Goldman Sachs that is talking about resilient demand. This does seem to be more of a supply issue than a demand issue when it comes to oil prices. And today you are seeing oil slightly higher. This means that the market can absorb these extra barrels of oil. And then you've got the tariff delay till August 1st deadline. So this is those factors are bullish for oil. But longer term, I will say that the street is expecting oil prices to be lower. So you are going to see oil prices lower, barring any Middle East conflict or anything else that happens for the supply side. But certainly for shale, this is a problem.
Adam, anything, what are the charts saying on oil? You heard some of Ines's comments here. Is $50 a barrel oil a possibility?
The technical story, oil is in a downtrend, simple as that. If you don't get a reversal on a war breaking out in the Middle East, one that included U.S. airstrikes on Iran, I don't know how you reverse that downtrend. The supply side certainly an issue. There's support, though, for WTI crude oil at right around $55. Maybe that will mark the low end of a range. We did have quite a bit of buying interest, short covering around that level. But to get through that downtrend, you're going to need to see a close through at least $78 on WTI, clearly a ways from that level now, in a very complicated macro backdrop. And I think China is another big factor here. What do the tariffs look like there? They've thrown a lot of money and stimulus at their economy. They're the world's largest importer of oil. Haven't had much traction on the economic side at this point.
Allie, last word to you. I would have thought oil at 65 would mean global economic slowdown. Now, we have seen signs of economic slowing. We even saw in the last jobs report. I know it's surprised to the upside, but still, it was a slowdown compared to trends we saw last year. Anything of concern for you in this latest move in oil?
Well, I think it just points to how sensitive investors are to the macro picture. I mean, it wasn't that long ago that we were talking about potentially oil going to 120, 130 bucks a barrel, and now we have oil firmly below 70 bucks. Now, I do think you could look at it as a potential catalyst when it comes to inflation. Over the past few months, lower energy prices, particularly lower gas prices, have led to the declines that we've seen on the inflation side, and that's been a big thing for the consumer at the pump, being able to offset some of those price increases that we could continue to see on the tariff side here. But we've been getting a lot of mid-year outlooks, Brian, and most Wall Street analysts say that the U.S. will be able to avoid a recession in the back half of the year because the fundamental story largely is still in place. Yes, we're seeing signs of a slowdown, but no firm deterioration at this point. So I don't think we are going to see a recession this year.
Y'all are no fun. I was hoping somebody called a recession so I go right back to my desk and write that story up and drive big views. All right, big thank you to all my contributors. You guys are the best. Coming up, Yahoo Finance's Market Catalyst. We bring you the news behind the market moves for the trading day. Do stick around.